Economic Armageddon may start in Australia. Martin North, John Adams, in the interest of people. Hello, John.
Hello, sir. How are you going today?
Very good. Good to see you once again.
Yes.
Now, you've been jolly busy writing this article.
Yes. Well, look, what I decided to do over the last few weeks, my mind has slightly changed in terms of what the thesis is. So just to go back, I've been saying we have a big problem. We have the biggest debt bubble in the history of the country. At the same time, we've got the biggest debt bubble in the history of the world. We have massive structural imbalances in the Australian economy, whether you look at household debt, foreign debt, property prices, the level of, in terms of bank lending, the level of concentration in the property sector. When you look at interest rates, when you look at lending standards, fraud that was exposed in the financial in the Royal Commission, all of these are very symptomatic of a big financial bubble, something very bad, and obviously the history of Australia has been that when we have had an economic crisis, it's always started overseas. So obviously, as I've been developing this thesis and talking to members of Parliament, I've always said that every time we've had a crisis, whether it's the 1892 depression, the Great Depression, even stagflation during in terms of the 1970s with OPEC, in terms of 1991, the stock market crash in 87, 2001, or the GFC, these crises have originated from overseas. And what I've said is we have a complacency in this country, the she'll be right attitude, we do not prepare, and then when something blows up overseas, a lot of innocent people get swept right through that because either individuals or the country hasn't prepared. So that's the thinking that I have expressed publicly, but also privately to politicians. And obviously I said that given that we've got a global debt bubble, $85 trillion of debt compared to 2007, the risk of a shock coming from overseas, that is very high. So whether the shocks from China, from America, from parts of Europe, Italy, for example, if something blows up in the financial system, it could spread to us and we could be swept right through it. So that's what I have said to date. But your conversation with Eddie Hobbs, and then some of the previous conversations we've had, but some of your presentations as well, comparing Australia to Ireland, has given me pause to say, well, maybe. So we've never been the first domino in 200 years or more than 200 years. And I thought to myself, well, there is a case to make that maybe we are the first domino. And after you spoke to Eddie, I had a private conversation with Eddie on the phone, and we traded a lot of notes. And Eddie, looking at Australia from Ireland, thinks we are going to be the first domino. So it's actually in economic circles a very radical proposition to put forward to say that we could be we could be the spark that blows up the world. We could be the first domino. But I thought because no one else is even putting this hypothesis forward, and in this piece that was published by news.com by Frank Chun, which is quoting me, you, and Eddie, we didn't say that we were definitely going to be the first domino, but we could be, and we've never been the first domino. So I think it was an important contribution to put a radical idea out there and say, hey, maybe we're looking at the problem completely wrong, and we should be thinking about whether we are first.
And one of the things I'd say there, John, is that most of the politicians and those in positions of authority here in Australia always will be able to point to an international crisis that created it. So they've always got plausible deniability, right?
Yes.
But if in fact we are going to be the entity that creates the problem in the first place, they have nowhere to hide, do they?
Yes. So again, I was in a politician's office last year, and he said that the establishment, from Treasury to Reserve Bank to APRA to government to people in Parliament, they know that we have a problem. They know that they have mismanaged the economy, but they're looking for a way out, including the banks. They're looking for plausible deniability so that they themselves, the people at the top, are not held to account. So how they're going to get out of jail? They're looking for this plausible deniability strategy, and that is the shock. That is the international shock. We can say, well, we were going fine, reasonable growth, low inflation, low unemployment, everything was okay, and then all of a sudden we got whacked by a 4x2, and we never saw it coming. that is what the establishment's trying to do. They have their buddies in the media. The media will push propaganda like they always do to convince the public that we didn't have a problem to begin with. But obviously, I told this politician, well, I'm around. I've been running for 3-4 years. I speak publicly, and I'm not going to let you guys get away with it. So that is definitely the strategy. So if we are the first domino to go, it will have a dramatic effect as to who will be held to account in terms of how this crisis may play out.
And basically, that means that a number of other entities will always try and argue it was always somebody else's problem.
Yes.
Right? It was always somebody else's fault. The Fed did this, or it was China, or it was Brexit, or it was something else, right?
Absolutely. So we are seeing some signs of global growth slowing, but nothing has blown up overseas. So just to give you through like a few examples I've got written down here. So 1892, the shock was Barings Bank in London in 1890. Barings had made some bad investments in Argentina. The Argentinians had defaulted. They nearly took Barings Bank down, and then that bank had to be recapitalised by the other banks in London, and that resulted in a massive contraction of credit coming into Australia, and that's what caused the 1892 depression. When you look at the Great Depression, obviously the stock market crashed in 1929 in New York, and then you had one key bank in Vienna defaulting in 1931, and that caused the depression in Europe and spread right throughout to us. Obviously, in terms of OPEC, I would say it's the closing of the gold convertibility window by Nixon, but then obviously there was the formation of OPEC and this cartel behavior to really drive up the price of oil, caused massive amounts of inflation at a time we had low growth in terms of the 1970s. You look at the 1991 recession. Obviously, we had recessions in the UK as well as the US, and obviously that slowdown in global growth impacted us. So that sort of came from overseas. Although leading into the 80s, we had a massive amounts of credit growth, very aggressive credit growth, but that wasn't being fed into households, they're being fed into the business sector. So this is why the Christopher Skase, the Allen bonds, these were the ones that went bust because they borrowed way too much. So that's sort of started there. Obviously, Asian financial crisis started in Thailand, spread throughout Asia, and then we didn't go into recession, but we were affected quite a bit by that. .com, obviously that started on Wall Street, and then GFC, it started with so it started with subprime, then it went into Lehman Brothers, and that basically impacted us. So that's those are some of the major crises that we have seen, and obviously I haven't mentioned 1987 in terms of the stock market crash. Stock market fell 87% in a day. 25% in a day. So that obviously again originated coming out of in terms of the United States. So we've never been the first. We've always had the plausible deniability. It wasn't us. It was overseas. But one of the things that we did on one of the previous episodes, and then you and Eddie spoke, and then you've done some separate videos on DFA, is looking at the structure of our household sector and the Irish household sector, and it's very similar.
Yeah, lots of debt, lots of housing, lots of people with financial issues, and then effectively significant pressures on those households. And of course, as house prices begin to fall, there's a whole cascade that follows.
Yes. So in the notes I provided to Frank, and he sort of cited a number of them. We looked at the quantum of household debt in terms of property prices, in terms of the amount of lending in terms of the banks into the household sector. Look, there's obviously a whole host of very similar things. I think previously you said that household debt to GDP, we were at about 120.5%. Ireland was, I think from memory, I only got it up to about 100. When you look at household debt to disposable income, Ireland got up to 200%. We're at 188%, so it's still substantially more than what the US was. When you look at in terms of net household wealth by asset class, while the Irish were 83% into property, we're 67%. And so obviously America was only 48%. So you know, there's a lot of similarities. Obviously there are some key differences in terms of they didn't control interest rates. We control interest rates in terms of we have our own currency. They don't have their own currency. So they have a few other factors that either forced the issue on them with rising interest rates, or there was limited policy tools that they could stop it. But there is a lot of similarities in terms of their bubble and our bubble, and obviously we are starting to see property prices decline. And you know, we've had several off-camera conversations about why that is. I mean, the data is very clear. Credit growth into housing started to slow significantly after November 2017. I mean, from March of 2017, APRA announced the cap on interest-only loans. You saw a slight downtick in investor loans, but there was a compensation in terms of a slight uptick in owner-occupier loans, but the overall rate was fairly consistent between March and November. But after November, it plummeted, and so I have concluded that the Royal Commission, played a significant factor. I mean, we saw through the Royal Commission systemic levels of mortgage fraud, whether it's in terms of the HEM, in terms of a few other factors there, and basically that has been the catalyst. Now, I had a conversation only 2 days ago with someone who has unique insights and access into one of the big four banks, and basically, because before the formal announcement of the Royal Commission, there was a lot of rumours in Parliament that a Royal Commission was coming. Everyone knew it. Obviously, the bank lobbies were all over Parliament. So during that period of November 2017, headquarters for one of the big four banks started issuing letters to the state managers and started saying, you need to clean up the mortgages. You need to stop effectively the fraud. And so this is the catalyst for why property prices are coming down. And obviously we're starting to see the ABC reports today that in the last 12 months, construction jobs 40,000 construction jobs has been lost in the last 12 months. And so the question from here is, does it stabilize? With property prices falling, with certain developments being banned, certain development companies going bust, we're seeing a contraction in discretionary spending like cars. If you want to call it the negative or the reverse wealth effect. So the question is, does this stabilise or does it unravel? Now, what did Eddie say? That prices in Ireland went 5, 10, and then it plummeted. And so I've had several conversations with Eddie, and we've traded some notes around what did you see anecdotally that we should be looking for in Australia that will give us an indication that this is not going to stabilise, but it's going to pancake, it's going to implode upon itself. So I've got a bit of a checklist that I'm looking for in terms of potential indicators. So I don't think we can definitively say that it is going to pancake, but I think one of the key things that he has emphasised quite a bit is psychology. Do people remain calm? Do people panic? If people have put their life savings into a property, massive amounts of debt, and then they start to get into negative equity, they may start to either lose their job or get cut back on hours. Can they service that debt? Do they remain calm? Are they going to continue to spend, continue to borrow, or will it be a self-fulfilling prophecy, and will it sort of end in a tailspin? And that is the $64 million question. But if Ed is convinced that we will unravel. And so Shane Oliver in this piece basically said that we will have peak to trough in Sydney at 25% and it'll stabilise. Well, Eddie sent me, after the piece got published, Eddie sent me a message and saying what the establishment like AMP don't understand is the level of panic that will happen if property prices fell 25%.
Yeah, and I'm seeing some of this in my surveys, right? So where prices started to slide, people were saying, we're not too worried about it. 5% down, 10% down. But once we got above 10%, people were a little bit more concerned, right? But there seems to be a bit of a watershed at about 20%, right? Once you get into that 20% and below, remember that a lot of people will have bought properties with a mortgage of 80% or 85%. So they're actually quite often in negative equity, right? And that suddenly means that, of course, all that money they put in has disappeared.
Yes.
Right? So that's the critical first point. The second point is then people start thinking, shit, I better get out quickly and try and sell, because if I don't sell, I'm going to lose more equity.
Yes.
And we're starting to see that in our latest surveys. We actually showed that in our surveys from 3 or 4 weeks ago, that now more people, particularly down traders, are saying, I need to sell. And I'm prepared to drop my price to get out. And so that momentum continues to build further. And so I have my doubts as to whether it's feasible to put the brakes on at 20% or 25%, right? I suspect we're going to go down quite a lot further. The real question, though, is house prices coming down is one thing, but will it spill over into the broader economy, and will it effectively create a broader bust in the economy? And that's the difficult part to try and work out.
Yes. Now, one of the things that some of the establishment economists are saying is, well, I can't see the shock. So a lot of people are saying, and obviously it makes intuitive sense, that if you've got a big debt bubble and you raise interest rates, just like in the lead up to the GFC, that's going to bust. Some people are saying another shock could be unemployment, but we saw a slight uptick today in unemployment in New South Wales and Victoria, but it's still too early to say that there's a systemic problem with unemployment. So they're going, well, where's the shock? Now, I would say that we probably have seen 3 shocks that the mainstream really haven't picked up. One was the Royal Commission, because that's affected credit growth. The second shock was Opal Tower, because that, and I think you've said to me about in terms of the flammable sort of material in some of the buildings, this has had a dramatic impact about confidence about purchasing property. So that's obviously had another impact around, fueling the bubble in property. And then in the third one, and I think this was some of the work done by Westpac, is the announcement that we had a per capita recession. And it's interesting because someone in Newcastle calls me up and says he's been talking a lot about these issues, watching our channel. His co-workers in a coal mine said, whatever. But once they picked up the Newcastle Herald and saw the article, a per capita recession, that actually, interestingly, had a psychological impact on them. So for them, you can say whatever you want on YouTube, but if you pick up the local paper and the local paper saying per capita recession, we're in it. They're still among those asleep. They still have enormous trust in the mainstream media, and if they are saying there's a recession, that has had an impact, and we saw, I think, in the Westpac consumer confidence surveys, that confidence fell 8% on the back of that. So and obviously this is where Eddie's saying is that negative news reinforces negative news, then that affects into economic decisions around pulling back on consumption in terms of spending. And then the question about broader impacts is, well, when you have a bubble, the bubble attracts real resources, and so we have, in my view, too many people employed in retail, too many people in real estate, too many people in construction. So there'll be a shedding of jobs in those sectors as this continues to unravel. I mean, because the reality is they cannot reflate the bubble unless if they basically go back to the fraud and really push the limits of lending. We're going to see continual falls for at least the next 9 months of property, and the more property goes down, the more negative equity, the more people lose confidence in their personal situation, etc. So we will expect to see unemployment go up in construction, in real estate, and in retail. And the question is, can another part of the economy pick up the slack? Now, in Ireland doesn't have resources. Now, we have a mining sector. We have seen a slight uptick in job vacancies in the mining sector, probably not enough to compensate the fall in jobs going in these other sectors. But that'll be the big question. Can the economy rebalance? Because if it can't, you're going to start to see an increase in arrears, defaults, and then that will be Ireland. So there's a very logical case to make that Ireland could happen here. We could be the first domino, but it's not definitive.
And there are things that the Reserve Bank can do in terms of cutting interest rates, right? There's a bit of room there. They could decide to loosen the credit taps a bit more, and go back to much looser standards. Some would say fraudulent standards, right? Although the regulators don't seem to want to do that at the moment. But I'm quite intrigued by the broader impacts of the fact that home prices are falling. The home price index that came out this time around from the ABS made a point that $133 billion is wiped off the value of property in Australia, right? That's the third quarter that's happened, right? That's a really significant thing because people have been used to property always going up.
Yes.
So you start putting all of those things together, and you just say there are a whole bunch of question marks. It's too early to say, though. So I think we've got to watch over the next few months for some of those leading indicators to give us a view as to whether, in fact, the falls will continue and whether, in fact, the contagion that we've got here then begins to spread more broadly. Remember that, of course, a lot of our banks are reliant on international funding.
Yes.
If, for example, international investors started to think that the Australian banks were actually a bit shaky, then they might be less willing to invest or only basically invest at a much higher premium. That would put more pressure on the banks. So you can build an argument for how this could play out negatively, but I think you can also build an argument to say there are things that can be done to stop it, potentially. But tough to do, and it may be too late.
Yes. Yeah, one of the things that a lot of people don't appreciate is that gross foreign debt is about 2.3 trillion. Half a trillion is 90-day debt. So we are heavily exposed to international credit markets. And obviously, if you think an international shock was coming, well, the foreign debt would be one of the transmission mechanisms in which it would come in. But if our banks are in trouble, that could be one of the transmission mechanisms that it could go out. And obviously, one of the things that, just on this issue of panic, because Eddie talked about households getting in panic, but he also said that the banks got in panic. And it's interesting how we've had some announcements this week about they're not going to lend anymore for self-managed super funds into property. I have heard examples of certain people either being forced to liquidate their properties because of their debt position or being called in to have credit reviews. So we are seeing more caution from the banks. I mean, is that caution sufficient to say panic? But if property prices continue to fall and a lot of these loans get into negative equity, I think the banks are going to become more nervous, pull back on credit more. This is exactly what happened to Ireland. Self-fulfilling prophecy, and then obviously you will start to see some massive issues with mortgage-backed securities. And then the question will be: will the government step in or the Reserve Bank step in to boost the MBS off? What is the cost of that? What's it going to do to public sector debt? What's it going to do to foreign debt? What's it going to do to the value of the dollar? Confidence in our economic circumstances? So remember, my thesis of Armageddon is one of 6 scenarios. Having a full-blown depression could be one, but if they try to protect the debt bubble, to the hilt, we could easily see the local currency crisis, or we could see, we could see us having a balance of payments crisis, and maybe, as certain economists in Melbourne have said, we could potentially default on the foreign debt.
So, what do you think will be the top 2 or 3 indicators that we should be watching now at this point, right, to know whether in fact we're going to get into deeper difficulty? Are there things we should be watching specifically?
So a few factors that I've spoken to Sean Quinn, who was there in Ireland, spoken to Eddie. So a couple of things I was obviously looking at, what was happening in employment in those particular sectors, retail in terms of real estate, in terms of construction. What's happening in terms of discretionary spending. We're seeing with cars there's been a pullback on that. What's happening with the savings rate? So the last national accounts we saw savings just tick up for the first time. So that may be an indication in terms of a loss of confidence. One of the things that they did say was look at what happens in terms of cafes. Are people going for takeout lunch? Are people going for the regular sort of $5 or $6 coffee, or are they going for cheaper options? So you start to see a few factors like that may play a part. Now, one of the interesting things that Sean said to me was that during this period there was a spike in oil prices, and the oil prices came to the Bowser. And that actually had a massive impact on the budgets in terms of households in 2007. So the question is there another non-debt, non-property shock that could affect in terms of in terms of household budgets that could really squeeze people, because households, other than the debt, they're being squeezed in a whole host of different angles. Well, it could well be that the drought. Now, if you go to the local supermarket, fruit and veg and meat are very high prices, and that could be the equivalent of the oil price shock that the Irish saw, that we're seeing, that because ultimately Armageddon is when people default on debt. So if they're being squeezed in their day-to-day costs, that means that they've got less dollars, because everyone's got to eat, everyone's still got to travel in their car. So if they're being squeezed in other parts of their household budget, and that's going to make them less able to meet their debt servicing costs, well, that again could be a contributing factor to the ability to service some of these debts.
I have to say, I hadn't thought about the drought and the impact of the drought, but it is actually quite profound in many parts of Australia at the moment, right? And I'm also thinking that other things that I'm seeing in my surveys, we know the price of electricity is a real issue, right? We know that childcare costs are a real issue. And we also know that healthcare costs are a real issue, and particularly healthcare relating to insurance premiums for private health cover. So,
yes, and so just on that, so obviously a lot of the conversation we've had today is that we've got a lot of debt in property, but I mean, it has been raised by Bob Catter in Parliament, but we also saw some of this in the Royal Commission. There has been substantial amounts of debt being pumped into farm properties. So obviously, if the drought continues, if these people can't generate income to service these loans, if there is no sort of drought assistance or to meet these debt obligations from government, there could well be examples of an increase of arrears or defaults in the farm sector if the drought doesn't break. So there's a few factors that may play into how the serviceability of the debt sort of may come into question. But once everyone gets nervous and the defaults start to mount, it's game over.
Right. And I guess that's one reason why we could argue that the politicians and the media are wanting to be upbeat and talk about it, and there's no issue, there's no problem, because they don't want to scare the horses, right? Because essentially they know that if in fact people do actually start waking up and seeing what's really going on, potentially that will have a negative impact, and that spiral could then become unstoppable.
Sure. So the establishment could say, okay, we're doing a public duty by trying to calm everyone down so it doesn't unravel. But the propaganda was the reason why we got into the problem in the first place, because we saw this massive run over debt. No one held the RBA to account in terms of interest rates, or the banks in terms of or in terms of APRA, and everyone said, we're in utopia for all of eternity. Get into property, double every 7 years. So you can't have it both ways. The propaganda caused the problem. We could actually resolve, even though there would be significant pain, we could travel along the way to solve some of these problems if we were more upfront and honest with the Australian people about the real dilemmas of our economic circumstance. But if they say we can't panic people, well, it doesn't matter, and to be honest, I'm really starting to think that the mainstream media is going to have less impact, because trust in the media is down, trust in politicians are down, but what's really going to bite is people at the kitchen table looking at their budgets, looking at their balance sheet, and if that's going down, it doesn't. If everyone says, if your house is on fire, or your financial budget's on fire, and the government says everything's fine, well, and I've said this to people in the coalition, politicians, you are going to lose the election because of the economy, because the propaganda that Morrison and Friedman are saying to the public do not buy, because their personal circumstances do not reflect the government's message. So I've said to them, why do you keep on saying everything's great, everything's strong, when the Australian people don't feel that on a day-to-day basis? And they've said, well, what else can we do? We can't tell them the truth. You can't tell them the truth. Well, what's going to happen? You're going to be thrown out of office.
And it's worth saying, I think, that the DFA household surveys, right, actually get real frontline information in relatively real time from households. It's probably the best sample of data we've got. And the pulse that I'm taking from real households dealing with real issues, dealing with real budgets, is they do see that they have issues, and they do feel they have problems. And the feedback that I come from those surveys is they don't understand why those in power, those in authority, can't see it from their perspective. It's like different world.
Yeah, well, I mean, I will be confronting the establishment on Monday, so hopefully I can, in my public way, get the establishment to wake up. Now, I think they're awake, but again, if they say no one saw it coming, I will be on Sky Business, and once this all blows up, they can't say no one saw it coming because we'll be there.
John, thank you very much.
Thank you very much.
Martin North, John Adams, in the interest of the people. See you next time.